Hello, everyone, and welcome to another episode of the Uncut Gems podcast by Bitcoin Suisse. My name is Marcus Dapp, head of research, and today my interview guest is Muneeb Ali, co-creator of Stacks, CEO of Trust Machines. Welcome, Ali, to the show.
Thanks for having me.
I think it would be nice to start with you personally. So the two simple questions are, when did you enter the Bitcoin space? How, why? And when did the idea of Stacks come around, and when and why did you start Stacks?
Yeah, so I think my journey with Bitcoin started in 2013. I was a grad student at Princeton at then. I was finishing my PhD in computer science. And me and my co-founder, we wanted to do startups. And we were like tinkering with various things and randomly discovered Bitcoin. And after that, we just went down the rabbit hole. So for a couple of years, like I took a leave from my PhD program. We were trying to build directly on the Bitcoin L1. So we built like this decentralized domain system, which is still around, called DNS on Bitcoin name system. And that was built directly on Bitcoin L1 back in the days. And I think around 2017, we saw very clearly the scalability challenges of Bitcoin, and not just the scalability challenges, but also the limited scripting language that we were working with. So in some ways, like we have the battle scars of directly building on Bitcoin L1. And a lot of those lessons of how limited Bitcoin script is, how challenging it could be to scale Bitcoin, especially when the gas fees go up. So in 2017, for example, people were paying around $40 in gas fees to register a $2 domain name on BNS. Right? You can clearly see like this is not scalable because we are at like 100,000 users at that time. It's not even that we are at millions of users. So it became crystal clear that we need Bitcoin L2s. And so Lightning started, so Lightning and Stacks started around the same year, so late 2017. That's when I finished my PhD as well, to put an end to that chapter of my life. And we raised capital for the Stacks project. That's how Stacks started as a Bitcoin L2.
Very cool. So what's the state of Stacks today? I was checking the price, of course, because there's a token and there's a price you can check. It's been surging quite a bit since the beginning of the year. So congrats on that. You are doing quite well. There are upgrades in Nakamoto and other things upcoming. But let's talk about STX. And I think the obvious question in the Bitcoin ecosystem is, why is there a token? Why does Stacks need a separate new token? And what's the purpose of it?
Yeah, so I think the token is really, the way to think about this is there is a trade-off between decentralization and having or not having a token, right? For example, you can compare Stacks with Liquid, which is built by Blockstream, and Blockstream and some of their partners, they effectively run the chain, right? So you blindly sort of trust them to run the chain. They're running the nodes. It's a federation. And similarly, for when you're transferring your Bitcoin into Liquid, you're effectively 100% trusting the multi-sig holders, right? They have no incentives, like they have no capital at stake. It's like blind trust sort of a model. Whereas when you look at Stacks, it's an open permissionless network, similar to Bitcoin L1. So why is Bitcoin decentralized and permissionless? Because the miners, anyone in the world can become a miner. They don't need permission from anyone because there are incentives. Like you are like spending some capital in electricity and compute power, and you can become a miner on the network. Similarly, with the Stacks L2, you are spending BTC, so that's capital that you're spending, but it's permissionless. Anyone in the world who has Bitcoin could actually become a miner for Stacks. And similarly, there are incentives, right? There are incentives for people to maintain the L2, just like there are incentives for Bitcoin miners to maintain the blockchain at the L1. So imagine that Stacks has data that gets hashed into Bitcoin. So all of anything that's written on Stacks, all the smart contracts, all of the data, you can verify that the data is correct by looking at the Bitcoin state. But someone has to keep that data. You don't want to depend on any company or any centralized party for keeping that data. So STX is the infrastructure incentive for people to maintain the state of the L2 chain, all the data, and to come in and become miners. And it goes beyond that as well, because then these same people with the launch of Nakamoto and SPDC would be the signers on transferring Bitcoin between the L2 and the L1. Right? So instead of blindly trusting some multi-sig holders, you have this decentralized group of signers that have economic sort of like incentives in place. They have capital locked, who would be like the signers to transfer BTC between L1 and L2. And I think those incentives are very important for decentralization. So I view that as a trade-off. If someone is really opposed to having a token, then you have to make your peace with trusting a federation blindly, right? And if you don't want to have that, then you have a token and you have incentives to have an open permissionless network at the L2 level.
I see. Maybe let's go into that a bit more. The interesting thing with stacks is you have this group called miners, you have this group called stackers, and you have this process called proof of transfer, POX. Could you elaborate just a little bit for the listeners how that all works together, why there are two groups of people, and how do the incentives work?
Yes. So I think, so first of all, at the high level, I think this actually goes back to a famous Satoshi code, which was, so this was a discussion on the talk that they were talking about how other applications and other chains can be built. And Satoshi was of the opinion that it will be really nice if these other applications, I really think they weren't using the term L2, but they're really talking about L2s at this point. They can actually share the hash power or the compute power of the Bitcoin network. And it actually makes a lot of logical sense because at that time, Satoshi was talking about that if for every application you have to start your own chain, then the hash power is actually getting divided into hundreds of different chains, which in some way was happening in the early days, right? There were many different proof of work sort of chains. And then it converged, and Bitcoin is by far the biggest, most dominant proof of work chain out there. So Satoshi's point was that it's much better to concentrate a lot of hash power on a single chain and then try to reuse it for building other L2s and other sort of like applications instead of having much smaller networks that all of them are very easy to attack, right? So one large network is much harder to attack for any single party versus a lot of small networks that are very easy to attack. So I think that's where the idea really comes from. Can we reuse Bitcoin's compute power? And the first version that went live, so there's a first version of Stacks that went live in 2021, early 2021. It's like slow in the sense that it runs at Bitcoin speed, and it uses this mechanism where miners are spending BTC on the Bitcoin L1 to mine the L2 blocks. And they write the hash of the L2 block on Bitcoin. There's some security, so much benefits with it. But then there's a Nakamoto upgrade, which is the work over the last 2 years, which is a massive upgrade on the system. And I can describe both these versions so people get a picture of it. So in the current version, as you mentioned, there are two sets of actors. One are miners. So these miners are producing the L2 blocks. They're writing them on the Bitcoin L1, and they're basically spending BTC to earn the right to being a miner. Just Bitcoin miners are spending electricity, and then there is some sort of a random function through which there's some probability that you will win the next block and you will get to write it. These people are spending BTC, and they have a random sort of probability weighted by how much Bitcoin you're spending that you become a miner for the next L2 block. And the folks who have STX capital, so STX is the incentive. That's why these people are bidding in this process and spending BTC. The people who lock STX, they are actually the receivers of the rewards. So that's why STX is a very unique asset where it has a BTC yield attached to it. I think that yield is around 5-6% right now, and it's coming directly from consensus, right? And so it's a very base level embedded in the protocol type of a function. And there's something like $1.4 billion locked in consensus right now. And these people are earning yield at today's rate. I think there will be something like $150 million in BTC going out to these people, who's pretty significant, right? And the folks who are locking capital, they're helping with stack security as well. I wouldn't go too much into the technical details of that, but let me switch over to what happens after Nakamoto. So what happens after Nakamoto is the stack's security budget is also getting a massive upgrade. Stacks is becoming much faster. So right now, a L2 block happens only when a L1 block happens. And Bitcoin we know is slow, right? Like 10 to 40 minutes for a block. Yeah. I think that's a massive upgrade that you're going from 10 to 40 minutes block times to something like 5 to 10 second block time initially. And they can keep getting faster now, right? Like the way we have cracked the problem is that we can tell that time is passing in between Bitcoin L1 blocks. So L2 can keep producing faster blocks like with every upgrade. And as soon as the Bitcoin block comes, everything settles on Bitcoin. So that's one big upgrade with Nakamoto, that you can have fast L2 blocks while having Bitcoin security whenever the Bitcoin block comes. And the second thing is that Stacks is getting a massive security upgrade. So again, I wouldn't go too much details of the existing system, but think of that as that, yes, it was reusing Bitcoin hash power, but still the security wasn't like one-to-one for Bitcoin security. And with the Nakamoto upgrade, so Stacks reorg resistance means that someone wants to reverse a transaction that happened on the L2, or they want to reorder the transactions that happen. So reorg resistance is one of the most important like security properties for blockchains. Like Bitcoin's security is effectively how much money someone will have to spend to come and reverse a Bitcoin transaction or to reorder the Bitcoin transaction. So Stacks L2 after Nakamoto will have 100% of Bitcoin reorg resistance, which is, I think, huge because then people can do transactions on the L2, which are cheaper, which are faster. And as soon as a Bitcoin block comes, you effectively have the same guarantee that someone will have to come and reorg Bitcoin to be able to reorg the Stacks L2. And I think those are two big things happening. Nakamoto, and maybe we could talk more about SBDC and how to move BTC in and out of the L2 as well.
Absolutely. Let's do that a bit later and finish on the fundamentals probably. Mining or being a miner is capital intensive. So varying degrees, obviously. But and correct me if I'm wrong, I checked online list of miners and how much BTC they put. And it seems like the top 10 or top dozen all had quite significant amounts. I think it was beyond more than 10 Bitcoin each, which is quite an amount. So my question here, is that correct? Because the probability to get a turn is related to the amount of Bitcoin you put. So there's this fairness question. And there's this question of capital intensity / centralization, decentralization, right? Not everyone has 10 BTCs to lock them somewhere. So how do you see that?
So I think the way mining works is you're not locking your Bitcoin. You're basically, you look at what is the value of the upcoming L2 block, right? And there are two parts of the value. One is the newly minted STX, the new STX that's being released. And the other part is the gas fees, like how many transactions are there, how much gas fee is there. So let's say I'll put a number that a Stacks block has a USD value of $10,000. So people know $10,000 are about to come out, and people are trying to bid on, I want the right to become a miner. So it's a bidding process, right? And because it happens every block, people do this over long time horizons, right? Let's call it a day or two or something like that. So you calculate your probability that if I'm bidding at these levels, how many times am I going to win? Am I profitable or not profitable? So what the miners are really trying to do is that they are trying to underbid slightly from the market rate of STX. So it's, in some ways, like the mining process is like an arbitrage between mining and the exchange rate of STX on exchanges like Binance. So miners who are profitable mean that they have figured out their software and their bidding process, and they've made it very efficient so that there's, let's say, some sort of a underbidding they do to be able to win the blocks. And an inefficient miner might be overbidding and actually losing money over the long term, which is very similar to, let's say you became a Bitcoin miner, you over-invested in hardware, you don't have access to cheap electricity, and you end up shutting down because other miners were more efficient than you and they were mining profitably. So I think you're not locking BTC, you're actually spending BTC. So it's almost like you're exchanging your BTC for STX, and maybe miners sell the STX and buy Bitcoin back. And doing that during that process, if they're profitable, if they're making some money, let's say there was a 5% arbitrage opportunity, so they're like making money by providing this service to the network. So that's one thing. The second thing about decentralization, which is a very important topic, one thing is that small people can pool together, which happens with Bitcoin as well. So you can have mining pools. So if, let's say, you don't have a lot of working capital, you don't have $100,000 lying around, you only have $2,000, you can actually go and pool with people, even if you just have $100 or whatever, right? You can be behind a mining pool. So that helps with decentralization as well. But the biggest thing is actually with the Nakamoto release, in some ways, the importance of miners is going down, right? Because miners at that point are going to become more like sequencers because they're just like proposing blocks. Now the STX holders who have locked capital, they become validators, right? So that they have to sign off on the blocks. right? So miners become sequencers, meaning that they propose, hey, I propose that
Yeah.
this is the new block.
Yeah.
Validators have to sign off on them, but miners or sequencers have nothing to do with the security or reorgs anymore, because it's 100% of Bitcoin finality. When the
Yeah.
block gets written, it's Bitcoin finality, right? So it's, in some ways, the importance of miners goes down. So they become less of a decentralization factor. To draw up a comparison, there are a lot of ETH2s who effectively have one sequencer right now.
Mm.
Right? So even if on day one we have 5 or 10 sequencers, that's a lot more decentralized than existing ETH2s. And I think the way the system is designed is actually pretty easy to become a sequencer as well with the Nakamoto upgrade. So I think I feel pretty good about the decentralization properties, especially after the Nakamoto release.
I see. Cool. Maybe a last question that will also be a segue into the next block on smart contracts in general. Do you want a high STX price or don't you want a high STX price, given that STX is the gas token and people need to pay fees, right?
Yeah.
For
So I
running.
think I would actually separate out two of these things. Right? So one is that the way the token economics works is that STX is a infrastructure token, right? It's for people who want to provide their services to having a decentralized Bitcoin L2. Really, that is what it is for, right? So there are already proposals in the community to use BTC as gas payments, right? That they haven't been approved yet, but at least they exist. And let's say the community, any changes that happen in stacks is a very decentralized ecosystem. There's a community vote, and let's say there's a vote on it, and BTC is now the gas fee. But the way the token economics work is actually very interesting. So remember, STX is an infrastructure token. It's for people who want to lock it and become validators on the network, and they want to earn the BTC yield. So it's a sort of like a yielding asset. If you put it to work, you get a BTC yield. If the gas fees go up, it actually doesn't matter if the gas fees are in STX or BTC. Whatever the asset is being used for gas, if the network has a lot of traffic and there's a lot of gas fees, the BTC yield goes up. Because now the sequencers are bidding more BTC for every block. So instead of, let's say, the block value being 10,000 USD, the block value becomes 100,000 USD because there's a lot of traffic and a lot of gas fees. The STX holders are now earning more and more BTC. Right? So that's the calculation around, hey, what is this used for? It's used to provide incentives to run the L2 infrastructure. Okay, so what is the incentives that people have? Their incentive is that if this network actually takes off and there's a lot of users and a lot of growth on the L2, then their STX is going to yield them a lot of BTC. And I think that's a very positive reinforcement in a way that it makes Bitcoin it helps create a circular economy for Bitcoin.
Yeah.
Like on the L2, we fully expect that most of the users will be for BTC. Like people will be deploying BTC in smart contracts. People will be trading BTC with other things. People will be using BTC in gas fees if this proposal gets approved.
Yeah.
So it's creating a BTC economy, but it's giving incentives to people who are maintaining the L2. So it's a very positive sum sort of a game that it makes Bitcoin more valuable, and it helps the people who are helping maintain this decentralized L2 that they have some economic incentives as well, that if this network takes off, they can actually profit from it. So it's a very open free market solution.
It's a quite elaborate system. I think it's fair to say a lot of thought has gone into in terms of incentive alignments, etc., which is, as we know, a difficult problem in all of blockchain world. So in all of that, to do what? Smart contracts, to allow people to run more than just transactions. So people who think smart contract, most probably their first thought is Ethereum, Solidity, and this world. And it's a huge world. There's a ton of developers. It's a huge community. So maybe it makes sense to draw a bit of a comparison between these two worlds, maybe even for a smart contract developer. So you have Clarity instead of Solidity, and there are a few other differences, but maybe also similarities. So maybe you want to just sketch out a picture comparing these two, because I think people are familiar with Ethereum, and showing the diff could be very
helpful. Absolutely. So I think you're absolutely right that a lot of deep thought has gone into this project, right? So going back to the origins a little bit, I think one of the smartest people that I've ever worked with or even respect in this world have actually contributed to Stack. There are multiple professors of computer science at Princeton who've been involved. There are multiple PhD graduates from Princeton, people much smarter than me. Yes, I was also a grad student there, but these people are really smart who have contributed to this project. And I think what motivated a lot of these early devs and scientists to come in was it was a really big, important problem to work on. Right? Bitcoin is by far the largest chain and by far the most amount of capital or the most decentralized. So it was such a big problem that if you could just unlock smart contracts directly on top of Bitcoin, that might just create like the standard for the world, like in terms of where most of the blockchain applications are run. And they would run on a very solid base. Like we truly believe in Bitcoin. So the way we approached the project was also like we have to build very solid foundations. And it shows up in everything. Like the way the project was launched was through a SEC qualified offering. I think it's probably the only project out there that had a full legal, transparent offering where everything is disclosed. The general public in the US could participate. And but that's like one decision. I would say every decision made in this project is with 10 plus year time horizons that what the world should look like if blockchains really take off. So we actually think that it will help a lot. Just imagine there were different standards for what the internet should look like, but it helped everybody when everyone converged on TCP/IP, when everyone converged on, hey, we are going to use HTTP or something like that, because users don't care about the underlying piping, right? They just want something that works and that is global and is accepted everywhere. So we fundamentally believe that BTC is going to be that asset that dominates globally and we want to create a BTC circular economy, and we want everything to be secured by Bitcoin hash power. Again, going back to the Satoshi comment that instead of having like 100 smaller networks, you want to have one extremely secure, extremely decentralized network and build everything on top of it. So with that in mind, I think what we're doing with Stacks is this long-term thinking that if this really takes off, the incentives are designed to have a positive reinforcement of everything. Right? That's why like Bitcoin becomes more valuable if Stacks L2 takes off. The early like people who are helping the Stacks L2 have a positive sort of like economic incentive as well and so on. Same with smart contracts. Like we thought deeply about this, did a lot of R&D work. Scientists from both MIT and Princeton were involved with this. And the fundamental thing that we realized is we have never kept money on computer programs before. And the computer programs, yes, they were doing important things, but they were never keeping money on. Like literally inside a computer program, we never had money. And this money could be like hundreds of millions or billions of dollars, right? So that's why we were like, the programming language has to be optimized for safety of that money. Right? Everything else is like nice to have, like the speed, the expressivity, everything else. The number one that like if you had one job, the one job is don't lose the money that's inside the smart contract. So that's the fundamental principle that Clarity is based on. And we fully recognize that Solidity happened to be earlier. It's based on an easier to learn language like JavaScript. But we believe that Clarity is actually a far superior language because it's much safer. Right? And safety is the property that matters. And a lot of sophisticated engineers, once they learn Clarity, it's not that hard to learn. They actually come back and they give us the same feedback that, oh, I really enjoy this. The safety properties are amazing. Everything's much more transparent. I'm not saying you're not going to have bugs with Clarity. Of course you can, but the attack surface is much smaller. Like it's a very precise tool. It's much harder to hurt yourself by using a bad tool, for example. Right? So that's the difference with Clarity. And again, with smart contracts on Bitcoin, we see that as a huge market. It's almost, yes, people are running these experiments on smaller chains. They're learning various things. They're figuring out what types of, for example, DeFi primitives work. But we see Bitcoin as the main playground, right? Everything else is almost like a rehearsal. You're learning stuff, but to take things to mass market, to go to like hundreds of millions or billions of users, I think Bitcoin is going to be the place where all of that happens. And all of the learnings from the smaller networks can be used and they can inform the design of what should be built over here. So that has been like our approach. And the interesting thing is, because we made so many different decisions, because I think we were making decisions from first principles basis, like what's the right answer and not like looking around that what is the rest of the industry doing. Stacks always came across as a strange project. hey, why do they have this like POX thing between L1 and L2? Why aren't they doing just proof of stake? Why are they using Clarity? A lot of the decisions they were standing out and they were very different from the rest of the industry or whatever. Because if you squint your eyes, everyone is doing a proof of stake chain. Everyone is like building a EVM clone. And I think slowly people are realizing that these decisions were really thought through. Like, for example, the Bitcoin L2 topic. Why did we start building a Bitcoin L2 versus starting a separate chain? I think now, years later, people are realizing that, oh, Bitcoin L2s are actually really important and really needed, right? Like when Bitcoin gas fees are going up, they're realizing that. So I think similarly, people will discover that if Stacks gets over the initial hump of like people finding it, hey, everything is like different here. I think the design is so solid that it actually becomes much stronger as a bigger project than it is as a smaller project. Once people get over the initial, call it the bootstrapping phase, people would realize that the solid foundation can actually help you build a much, much bigger, stronger economy using Stacks than some of the other systems.
Awesome. Awesome. I have one last small technical thing. Let's spend half a minute on it. MEV, minor or maximal extractable value. Is it an issue on Stacks, and how do you guys deal with it?
Yes. So I think I would say the MEV is like an inherent property of any blockchain, right? Like it's basically if the economic value goes up, think of it this way, the Bitcoin miners today, because most of the transactions are just payment transactions, there's no real value that they can extract by reordering those transactions. But let's say someone builds a different thing on top. Let's take the example of ordinals, which are these Bitcoin NFTs, and they're using the concept of these like rare Satoshis. Now imagine that a Bitcoin miner could reorg a block because a rare SAT is coming out, right?
Yeah.
A rare Satoshi is coming out, and they're like, you know what? That thing might be really valuable. So I'm going to, instead of building on the longest chain tip, I'm going to try to reorg the previous miner. In some ways, that's introducing MEV to the Bitcoin L1 chain because now Bitcoin miners are looking at something additional to make the decision that do they want to reorg something or not reorg something. So I think that's that broader like thing in mind. The principle that we try to follow on Stacks is that we want most of the MEV to occur on the L2, right? Because you want L1 to remain durable and stable as much as possible. But we fully realize that if there's a large DeFi ecosystem happening, there will be MEV. Like any big ecosystem needs to deal with it. And there are many ways to introduce like good actors and try to make them participate in MEV and try to stabilize the situation. And without getting into that, I want most of the MEV action to happen on the L2 because then it's like shielding the L1 from some of the negative consequences of that. So I think if most of the DeFi traffic is actually happening on the L2, then the MEV on Bitcoin becomes shielded more. There will still be certain things in terms of, because you are building complicated systems and on top of L1, there's some things that we can imagine. There are certain things that we are probably not even thinking about. And I do think MEV on Bitcoin is almost unavoidable. It's just a matter of time. And you can try to be as careful as possible. So for us, the biggest thing that we've done is try to shield the L1 as much as possible and direct the MEV action to the L2 as much as possible. Similarly, with the Nakamoto release, there is even less MEV possibilities at the mining side than there were in the current version of Stacks. And I can get into some of those details. Basically, the thing is that the miners can't even reorg the chain anymore, right? It's just Bitcoin finality. So you take away that entire potential MEV attack vector that someone can be like, hey, I'm going to come and try to reorg the L2 chain by doing something at the L1. But you can't, right? Like it's just following L1 finality at that point. And so everything is directed as you, okay, go and try to just use Bitcoin as how it works right now already.
Let's move on. What are people actually using the smart contract functionality for? So let's talk use cases, right? What are popular use cases? You mentioned ordinals. So there are NFTs on Stacks, but there may be other things. So maybe give us a small tour of what are people working on, what's interesting for them doing
So I
Stacks.
think before Stacks launched, our like theory was that some of the DeFi primitives or applications that have emerged with some product market fit in other ecosystems, people will try to do that with the Bitcoin L2. And I think that largely came true, and I'll explain how. But then there are some unexpected new things people ended up doing as well, which I'll give some examples of. So in terms of what we expected, like if there is a DEX, like, or for example, Uniswap on Ethereum, where people can do decentralized swaps between assets. Like, why wouldn't people do that on a Bitcoin L2? And they did. So there's Alex. I
Yep.
think they recently crossed like $1 billion trading volume accumulated. I think it's a big landmark that look these things. And the 500 million of that is pretty recent. It happened in the last 4 or 5 weeks. I don't know the exact number, but pretty quickly. So I think that's one example. And imagine right now, full BTC trading is not even live, right? Because the SBTC is not live. People can't easily go from L1 to L2, deploy their BTC into Alex. And imagine Binance does like billions of dollars of BTC trading a day, right? And I think in a decentralized way, people would be able to do it on the L2. That's a big use case. Similarly, I think other people are trying to build like lending protocols, right? Where you lock up your capital. Again, it's going to be a big use case with BTC. You lock up BTC capital and you take a loan against it because you don't want to sell your Bitcoin. You don't want to get the tax hit. You just want to hold Bitcoin for a long term. But right now, there's no decentralized way of doing it. So imagine 2 years ago, people are putting their capital into BlockFi or Celsius, which are centralized companies that blew up. Right now, with the L2, we are enabling these applications, but in a decentralized way. And nobody controls a smart contract. You lock the capital in a smart contract, and that's why I think the computer language becomes very important. Clarity really helps here because again, it's optimized for safety. If people are locking up a lot of capital, then you want to optimize for safety of that capital as well. So I think those are like primitives that we theorize that people will come and build them very quickly. That has already happened. Like people are coming in and building all these things. In terms of unexpected things, I would say, for example, when inscriptions happened on the L1, someone built inscriptions at the L2. And the underlying reason was the Bitcoin L1 is expensive and it will keep becoming more expensive. But if you do an inscription on the L2, the hash of that is automatically going on the L1. So it's in some ways it's like a cheaper inscription. Yes, the data is not on the L1, but then all data can't be on the L1. Only I think the most valuable data is going to be on the L1. So it's an unexpected sort of like use case, which I hadn't seen anywhere else, where someone is using this really interesting property of stacks, by the way. Like for example, imagine that this simple concept that you can write anything to stacks and the hash ends up on Bitcoin automatically as soon as the Bitcoin block comes, means that you can use a cheaper data layer, which is stacks, but it's 100% verifiable at Bitcoin. So you're only ever looking at the Bitcoin chain to verify if this data is correct or not. And there are pretty strong incentives for that data to be around. Stacks has let's call it 4 billion market cap right now. The Stacks market cap will have to literally go to zero for this data to disappear. Because as long as STX has any market cap, like miners and full nodes have an incentive to keep that data around, and which is, I think, a pretty interesting property that you say that here's a smaller network, here's a Bitcoin L2. As long as it has any market cap, doesn't matter if it's 10 billion, 24 or 2, whatever the number is, this data will be around, right? And you can verify it by just looking at Bitcoin L1, which is absolutely going to be around. If something happens to Bitcoin, I think this entire industry goes to zero. But I think after that, I think this is a pretty strong property. I personally think it's a stronger property than looking at a alt L1 that might just disappear because it has its own security and its own mechanism that can just internally collapse versus something that's built on Bitcoin and has a better chance of survival.
So your recommendation to the Taproot wizards and their friends is come over for cheap ordinals and inscriptions on stacks.
Yeah. So I think the luxury NFTs in my mind would be on L1 and they will carry a premium, right? That, hey, the data is literally on the L1. But if you look at the long tail, if you're going to scale these out to 10 million users or 100 million users, we know today that's not going to happen on the L1. It just simply is not going to happen on the L1.
That's a good one, that you can do both, literally. Yeah. So the smart contract ecosystems around Ethereum, and there are others, of course, Solana and etc., over time, they also spawn a startup scene, like projects and small companies, small startups showing up, forming and building on on the platform. Do you see that on Stacks also already, or is it too early, or it's still too small, 4 billion maybe, I don't know. So what do you see on the ground, not only in like project, but also in actual startups?
No, yeah, it's absolutely, it's already happening, right? So I
Mm.
think when the project launched, we saw maybe something like 30, 40 startups launch. And if you look
Yeah,
at any startup ecosystem, not all of them are going to be successful.
sure.
So I think if 30, 40 launch initially, maybe my guess would be, I could be wrong, but maybe 10 to 20 are still pretty active. Some of them are clearly doing really well. If you look at Alex, for
Yeah.
example, or others, like Alex has a 400 million market cap. So imagine now there's a protocol built on top of a Bitcoin L2 that has a 400 million market cap. And we're like pretty early stages generally, given Nakamoto is not live, SBDC is not live, and Bitcoin L2s are people are just discovering them. I'll give you an anecdotal example. And by the way, these people are building their startups when not a lot of people were even willing to fund these things. So even a year ago, some of these builders will come and tell me that, hey, I'm trying to raise $1 million round. And I've talked to 25 investors and nobody understands what Bitcoin L2s are and nobody's willing to invest. And I've only raised 500K or something. And then I meet the same person 6 months later, and they're like, I was trying to raise 1 million and I ended up raising 3.5 and said no to 7 million because the market has completely changed.
Mhm.
And it's simply the click that went, the sort of the light that sort of went on was people started realizing they bought us some Bitcoin L2s. And we have actually done a lot of work there
Yeah.
in like education, awareness, content, general helping, sitting down with people, helping them understand why Bitcoin L2s. And I do think that when ordinals happened and Bitcoin fees went up, and people have to experience a pain point, right? When they're like, hey, I can't pay $40 in BTC fees, or the mempool is so backlogged, then they're like, oh, we need L2s. Like, people just got it because they experienced it firsthand. So that now is very positive for these startups building on L2s in general and stacks in particular, given it's sort of like the leading L2 right now, that now capital is available, which is again a self-reinforcing positive like mechanism, because now even higher quality developers can come in and even higher quality investors can come in because everything is kickstarting into motion. So it's a pretty exciting time to be in this ecosystem right now.
Cool. Being conscious of time, let's move to the last topic, and I try to put it into one or two questions. Let's broaden the scope a bit and look into this L2 scalability landscape on Bitcoin. I mean, yes, there's stacks, there is Arc, there are drive chains, Lightning, and on top of Lightning, people build RGB. There is Taro, there is CK rollups in the form of Citrea, there is, I don't know what else. Did I mention Arc? Nevertheless, so there's an emerging landscape, and Stacks is part of it. How would you position if some investor or some interested person looks from the outside? Where should I, or even a developer, like where should I invest my time? What should I look at? What do you find interesting personally, aside from Stacks? What are worthy competitors to Stacks? What not? Maybe just a few insights from you on that landscape.
Yep. So I think the way I would classify it is there are a couple of projects that are in the camp of basically state channels, right? And if you look at Ethereum in the early days, like 2017, when they started looking at L2s, so there was a group that was looking at state channels, and then there was a group that was looking at L2s that have their persistent state, meaning they have their own chains, right? Like they're pretty much like blockchains themselves. And the state channels ones, I think they're very different in the sense that they don't have global stake. Right?
Mhm.
So most of these approaches, like Lightning is the biggest one, right? So it has payment channels, and then the payment channel disappears whenever you settle it, but it doesn't have global stake. And then anything built on Lightning, so Taproot Assets Protocol, anything else, it inherits the same property because it doesn't have a blockchain, it doesn't have state. And that's why these things sometimes don't need tokens as well. So they don't have those incentives. And in the Bitcoin ecosystem, not having a token is a property that was very welcomed. So a lot of the work that you would see in the Bitcoin ecosystem, especially like pre-2023, is mostly around these types of systems, like that don't have global state. I'll broadly classify them into state channel.
Yep.
What happens with state channels is that I think if you look at the rest of the industry, like where most of the developers are, most of the users are, most of the standards that are emerging, they're actually not state channels at all.
Yep.
And I think I I personally am a person who tries to listen to the market.
Mhm.
What do developers want?
Mhm.
What do users want? So if developers just want to be able to send a transaction without worrying about liquidity or routing, or they just want to query what is the state of, let's say, a stable coin without doing anything complicated because it's literally written on the blockchain, right? Which is, it could be an L1, it could be an L2, whatever the chain is. So I think that's, in my mind, that's the biggest differentiator. The second differentiator, and again, it comes from having or not having a token, is that people, there are some things like Liquid and others that have state, that have the chain, but then they're federations. And over there, instead of being an open permissionless system. So over there, the question that I ask is, in this day and age, if you're a developer and you could go to a system like even Solana, even people, maybe rightly criticize it for being more centralized than other areas, but it's not a federation. You don't need anyone's permission to start running a validator or a node. Would you go to a permissionless network, or would you go to something that's a federation? Right. Federations can have use cases, but I'm just looking at the traction that all of these alt L1s or even L2s and Ethereum are getting. They're not federations, right? So I think Stacks is pretty much targeted at, Stacks is like the answer to the users and developers who are using alt L1s like Solana, Avalanche, and others, or they're using ETH L2s like Arbitrum, Optimism. That, hey, you can have a Bitcoin L2 that gives you similar properties, the properties that you want. And most of the systems, not all of them, I think they're different things. Like they're very different from that type of system. Some of the newer projects that are coming up, who are more in the ZK rollup side, or they're trying to build newer L2s, like starting literally this year and so on. I think they're more similar to Stacks than some of the first generation projects that I talked about.
Very interesting take. Yeah. That the token, non-token, yes, that makes a lot of sense. Have we forgotten anything? Is there anything left you would like listeners to know, like immediately, because you have the upgrades upcoming, the forks, Nakamoto? So anything you would like to cover in the last minute?
I think the one last thing that I would mention is when building Bitcoin L2s, one of the biggest criticisms coming from outside, let's call it the Ethereum world, ETH L2s and others, is that, hey, the Bitcoin L2s are not really true L2s because you cannot withdraw your BTC in a unilateral way, right? So you have to trust some signers. For Liquid, that's the federation. On Stacks, it's like the people who have locked up the capital and a decentralized group of signers, but there is a decentralized group of signers. You're not relying on just Bitcoin L1 to be able to withdraw your BTC. And that's the biggest criticism that has been around, that, hey, that's why Bitcoin L2s are quote unquote not real L2s. And then I want to give a shout out to this work called BitVM that came out recently. And again, it's a very practical project because it doesn't require any changes to Bitcoin L1. Of course, you can make changes to Bitcoin L1 and introduce new opcodes and have trustless L2s. But BitVM can enable what I consider trustless bridges. Like it basically, instead of having M of N security, is one of N. So you just need one honest party, and that one honest party could be you yourself. So it's trustless for you, right? Like you're not trusting anybody else. So creating those trustless bridges because of BitVM, and it's still being built, and I think it's still like a year out or something, really truly enabled the Bitcoin L2 market. Because now with a straight face, you can answer any criticism and be like, these things can be as trustless as any Ethereum L2. Because BitVM is a fraud-proof system. A lot of L2s on Ethereum, like Arbitrum, for example, use a fraud-proof approach as well. To that, I think BitVM work, I believe, truly enable like 100 billion Bitcoin L2 market where there can be multiple L2s, people can try different designs. And Stacks is obviously already looking into how we can benefit from BitVM, how we can help accelerate the development of it, and so on. So I think it's a project that's just going to help everybody. It's going to reduce the trust assumptions in building these L2s and really kickstart the Bitcoin L2 market.
The future looks bright.
Yeah.
Thanks a lot, Muneeb, for your time, for sharing these great insights into the Stacks ecosystem. I recommend to everyone to look into Stacks and what it's offering and all the activity going on there. I wish you and the team good luck for the Nakamoto upgrade. Fingers crossed and all the best. Thank you.
Perfect. Thank you so much.